All right, hello everyone. Chris Capri here, SecondSkiesForex.com. Welcome to today's webinar on the key tips for trading support and resistance levels. We are going to be covering a few more subjects beyond that, but the bulk and the gestalt of what this course or this webinar is about is to kind of amplify your understanding of relating to support and resistance and trading around that. And so with that being said, we're going to really focus on 10 key tips that you are going to want to learn and digest and understand and build them up so that they are skills, so that they are things that are in your subconscious brain, so that they're automatic. It is going to take time to build some of these things up. It is going to take time for you to understand these concepts, and it's not something that you just learn it conceptually and then you have it, and it's never like that with trading. Trading is a skill-based endeavor. It's a mental performance endeavor, and that means it takes time to build those skills, and it takes time to wire those skills into your brain. You can learn something conceptual you want. That doesn't mean you can actually use it as a skill. That doesn't mean that you can apply it as a trader in real time. When you can apply it consistently in real time is when those skills and those habits and these pieces of information are dominant neural networks in your brain. When they're stronger than your bad habits, when they're stronger than your weaknesses, when they're stronger than your emotional neural networks. And so it's important that we understand that just knowing this information doesn't mean that you can apply it. That doesn't mean you can do it. It's going to take time. Support and resistance, learning how to trade around support and resistance, is something that's going to take time to develop. And it's going to take time to learn to feel, and it's going to take some time to build confidence and get comfortable with. And so take your time with it. Don't be frustrated if you don't understand it right away. Don't be frustrated if these techniques work really well for some people and not you. That is all going to change over time. You just have to continue practicing with it, and you have to keep working with it. But eventually this will become second nature. Eventually you will be able to detect these key things, and you'll be able to read things a lot better. So with that being said, let's get into the first key tip for trading support and resistance levels as an amplification and clarification and kind of further digging and discovery and add-on to the moving away from confirmation part. That concept, that beginner's mindset that you need confirmation to enter a trend. And my focus is really changing that mindset, because that narrative has been very strong. And that narrative was because of one group called J16 Group, and they had a student, and that student is from Australia, and I think you know his name. And then he taught the same thing. He basically said, oh, I can do this. I can create my own product and make money off this. And said, okay, I'm going to teach the same thing. And so he did that without actually really digging into trading itself. He just did a carbon copy, cut and paste. And because he's really good at marketing, he's been able to push that narrative out into the world. And then, of course, other students had said, wow, this isn't complicated at all. Any old dope. And not Jonathan Fox. Jonathan Fox was later down the line. So, but that first person out of Australia had students, and they started to say, hey, any old dope can do this. This doesn't require any skill to teach. I can teach this. So then they create a carbon copy and paste thing. And pretty soon there are now 5 derivatives of that. And it's all a derivative. It's a derivative style of thinking. It's a derivative style of price action. And it's all carbon copy, cut and paste. And because there are a lot of people saying that narrative has been pushed out there very broadly. It's very strong out there. I didn't come from that group. I came from my own. I came from the world of the broker. I came from the world of the hedge fund. Every one of those people came from the same background. I came from a completely different background. I came from the hedge fund, the broker, the institutional world. And I didn't do a carbon copy, cut and paste. I really dug into the nature of price action. And I really kept digging until I could get to the rare earths and precious metals and get to the core of it. You know, I had to get past the mantle and the crust and really get into, keep digging and digging and digging, and I had to work with it. You know, I didn't go with the idea, oh, I just need 30 minutes a day and that's all you need. You know, 30 minutes and look at this and that's it, and, you know, and okay, yeah, you're going to be a professional. I didn't come from that fantasy world. So I took a completely different approach, and that's why I teach it differently. That's why I don't teach confirmation as a mindset or as a method. The first lesson and video that I ever did on price action was on impulsive versus corrective, and there's a reason for that. And the first video in this course is on impulsive versus corrective, and there's a reason for that. And so, as Apex is saying, context is king. Price action context is king. It always has, always will be, and that's where you want to build your skills. Now, it may seem confusing because in this course, we have some videos on engulfing bars and inside bars and pin bars. And I'm going to explain that later. But the message has always been the same, and the first videos in the course have always been the same. And it's always been the same that impulsive versus corrective, volatile, non-volatile, those are the most important things. Context is king. It always has been that way. And so I don't teach that idea that, hey, we can't get into a trend until it's confirmed, because confirmation is an illusion and it's a retail trader's mindset. I come from a very different perspective on trading. I did the work, I dug into it, I put in thousands and thousands and thousands and thousands of hours. And I've seen more bars than probably everybody in here combined. I've seen more patterns, I've seen more candles, I've seen more formations. I've seen a lot. And that is why I communicate a different perspective. And so, with that being said, to kind of give you, and I've said this 100 times before, but I want to keep saying it again because I want you to really understand it, is that in terms of what we are doing, we are always starting from context first. And to understand price action context begins with impulsive versus corrective models. I'm going to be redoing that video either this week coming up or next week, because I want to amplify my explanation of it. I want to talk about some other things. I want to put a fresh coat of paint on it, and not just change the optics, but also want to change the found. I want to say more. There's a lot more I can say about it now. And so I'm going to redo that impulsive versus corrective video soon, but we always start with that. The next thing we do is we determine the volatile and non-volatile type of trend that we're in. Those are the first two, and we always do it in that order. And then from there, only then do we start looking at key levels in the market, key zones. And we determine, okay, which ones are the key zones? How has the market reacted or responded to that? That's the third layer of price action context. And only then, once we have those three things, do we start looking for what is called trade location. Where do we want to get into the market? We don't look for trade location until we have those three things in place. You can say the third thing is trade location, but it's not. It's informing us where are the key levels on both sides of the market, to the top and the downside. Where should the market stay within if it is functioning well within the context? And if the context is broken, where should the market go or not go? Where should the market not go for the context to remain the same? The levels and the zones are part of that. But only after all that is done do we then determine where our trade locations are. So it's very important. I had somebody email me saying, okay, yeah, so it's all about support resistance levels. And I'm like, no, 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 you miss it completely. It's not all about support resistance levels. First and foremost, impulsive versus corrective. Second, volatile and non-volatile types of trends. Third, support and resistance levels and zones. Only after all that is in place do we start looking at trade locations. Because that gives us the picture, hey, here's the dominant trend, here's the dominant context. Based on that context, here's how I want to be trading it. Based on that context, and here's how I want to be trading it. Okay, where are my trade locations based on how I want to be trading it and the context? So no, it's not all about support and resistance levels. That's third on the list. But it's a very important thing because it helps us to kind of narrow our trade location. But you can't narrow the trade location until you have done the context first. So with that being said, that is what this webinar is about. And it's the third part of the price action context. And these 10 key tips, I think, are going to change the way that you relate to support and resistance levels and zones and help find trade location. So, and I'll be answering your question later in that, Marcel. Before you guys get into questions, you're getting into questions before I've even jumped into the material. So let me jump into the material and then see if you still have that question. So with that being said, let's get into the 10 tips. All right, tip number 1 for trading support and resistance levels. And I should say, when I say levels, I'm also going to say zones as well. And we'll talk about that. But I just want to make sure you understand that. So the first and foremost tip in terms of understanding support and resistance is that higher time frame support and resistance levels and zones have a higher probability of holding an intraday attack, especially when confluent or higher time frames are important, especially confluent when in alignment with the higher time frame context. So to repeat, higher time frame SR levels and zones have a higher probability of holding an intraday attack. And this is especially true, and these levels and zones are especially confluent when they are in alignment with the higher time frame context, trend with trend or range or whatever. So let's get into some charts and examples on this. And we're going to be using a lot of ones that I've been talking about. So the euro dollar here had that FOMC spike highs, and I think that's the largest one bar day of the year and maybe even several years. So that spike high was very interesting because for the market to go from mid 105s to 110 plus inside of a day is pretty impressive. What's interesting about it is that to climb almost 500 pips and then reject 200 plus pips down communicates that for that to happen, there was not only a lot of volatility, but there was enough of the with trend players to say, okay, this is enough. We don't think the market should be valued here. And they sent it back 200 plus pips inside of a day, in the face of a 500 pip gain on the day. So that should be communicative to us that there was a lot of bears still left in the market saying, we're going to defend this 110 area. And you know, it was probably, I don't think it was the case where it rose, ran into orders here that stopped the line and pushed back. I think it was a question of rising. Once it got to 110, players started to enter in and they started to absorb the buying pressure. And then enough of it came in continually above 110 to stop that momentum, reverse the momentum, push it back. So this kind of set a certain precedence around the importance of this level. Now, since then, we have been talking about, hey, you want to be selling on approaches to this level. We want to be selling around this level. And we can see that it rejected cleanly off here 3 days in a row in the face of a 2-day bullish move. Now, this is the second rejection. In the third rejection, which we also told people to be selling ahead of time, where do we say? Around 110.30. What was the high? 110.36 or 37 on the day. So it was 6 pips above our level, and that was it. If you were waiting for a pin bar here and trying to get some sort of 50% retrace streak entry, here's your entry. Here's our entry. Which has the better option? Ours does. Here, there was no confirmation. The market hit it, rejected it, climbed right up into it. That's it. If you're waiting for a 50% pullback, assuming this was a pin bar and it wasn't, you missed this entire trade completely. You missed something that I rejected 1, 2, 3, 4 times before. So this had initially set it put traders on notice. And if we had already said, let's sell up here, but the fact that it sold here again didn't surprise us. And so what did we say? Sell here again. Because the higher time frame context had communicated to us this was a level that was important. This is where the offers were willing to push back. This is the third rejection here. And again, no confirmation. Now, let's look at this, because a lot of you are saying, well, sometimes it runs into it impulsively. How do we know? We're going to get into that. But let's look at this same move, that third rejection on a 1 hour time frame. What do we have? Impulsive versus corrective, impulsive versus corrective, pre-breakout structure a little bit below the level, impulsive move heading right into it, no confirmation, no nothing, and then bam, market's gone. Even if this was some sort of magic pin bar, there was no 50% pullback. Even if you were selling on close, here's your entry. Here's our entry. Who's got greater profit potential? Who's got a better opportunity for a higher reward and lower risk? Who's going to have the greater edge based on the two? It's obvious. There was no confirmation ahead of time. Everything was saying, look, this is all bullish leading into it. And yet, it just stopped on a dime. It even had a with trend pin bar. And look what happened. Sellers immediately said, sorry, bam, no warning. And that is often how things will work. There will be no confirmation. There will be no information. Everything may look like it's going to break, and yet it held, and then it sent it back 200, 300 pips. Even on the 5-minute chart, it still looks relatively bullish. Climbs up, gets up here with trend pin bar, slight pullback, 2-bar impulsive move takes out the last 4 bars of selling. No confirmation. Within 10 minutes, this thing's already away from the level and you're running out of time every single candle that goes on. By the time you're here, look where you are. If you're waiting for confirmation, you're waiting for here, look where your location is. Who's going to have the better R to R? Who's going to have the greater profit potential? The person who has the better trade location is lining up where the institutional players are getting in the market. So it's important to understand this first key tip, and this is crucial, which is that higher time frame context. Going back to this one here, have a higher probability of holding an intraday attack, just like this, and these levels are especially confluent when they are in alignment with the higher time frame context. It's very important. Does that make sense? Yes, no? So Alistair, the question you're asking there is the wrong mindset. Was the fact that it rejected the level and closed the day below the 20 EMA also a confirmation of the level? Again, that mindset is the wrong mindset. We don't look at that as a confirmation of the level, especially this one right here. This is a one-day 500 pip move. The fact that it closed below it isn't going to be, if the 20 EMA was so important, we wouldn't have had a 150 pip breach of it. But again, you're looking at it as, hey, was this additional piece of information confirmation? It's the wrong mindset. Now, this doesn't mean we eliminate the word confirmation from our vocabulary, period, but we do want to look at it differently. We want to have a different mindset towards it. I'm not looking at it as it was below the 20 made, so that confirms that, you know, we want to stay with the downtrend. I'm looking at the fact, just the pure price action, that we had a 500 pip gain on the day, lows to highs, and somehow the offers were able to say, in the midst of the intensity of that move, they said, no, we're going to put you back. We're going to push you back 2 cents. To push back 2 cents of a 500 pip gain on the day, that tells you that there's strong selling interest in the market. So I'm not looking at it that way. Okay. How many touches it need to break the high support level? Again, that's the wrong approach. We can't look at it as number of touches, and we'll address that question later. Don't avoid the mistake of looking at support resistance in terms of pure number of touches. There's a way we can look at one, you know, like the second touch or the first touch, but we don't want to look at it as like, oh, well, it's hit 3 touches, so this level's default. We're going to find out it's just not true, and you can't approach it that way. You can't try and quantify levels that way, because sometimes more touches is bad and sometimes more touches is good. So so trying to approach levels and zones as how many do we hit that threshold doesn't work. We're going to demonstrate that later. Okay, key tip number 2. The greater the time frames, that's what TF is, the greater the time frames which support the price action context, the greater the chance an intraday support level will hold. When I talk about higher time frames, I'm talking about daily and 4-hour. We could say weekly as well, but I'm generally not looking at the weekly too often. It's maybe a couple times a month and that's it. So when I'm talking about higher time frame context, I'm always talking about daily and 4-hour. When I'm talking about lower time frame context, I'm talking about anything between the 1 hour and 5 minute. We could even say 1 minute is fine. Anything 1 hour and below is lower time frames in the way I approach things. So what this basically means is, hey, if we have on the higher time frame context, if we have certain levels which are support on that higher time frame context, and they also are support on an intraday context, the more of those things that line up, the stronger it is. So let's look at that. Dollar CAD, something we've been very active on and something we've been very profitable on this year. Dollar CAD's been one of our top pairs for this year. So I think we can all agree that this is a bull trend. I think we can also all agree that this is a corrective phase and range at the top of a bull trend. Anytime we have a strong bull trend, or even on an intraday basis, if you have an impulsive move followed by a corrective move, and that's what a range is, it's a corrective move or it's a corrective phase. Anytime you have that at the top of a bull trend or a bottom of a bull trend, that generally indicates that the with trend players are still in control. And that the next leg is most likely in the same direction. Now we can see that there is inside this higher time frame context, we know that the market's bullish. It's in a corrective phase at the top. So the context is bull trend, corrective phase at the top. So short-term range inside of a larger bull trend. That means that the buy levels are our best options and our sell levels are our secondary options. But this is the resistance on the higher time frame, and this is the major support on the higher time frame. When we dip into this to a 4-hour, and the 1 hour chart doesn't really look much different, we can see that that relatively applies the same. This is still the resistance. It's the same box. This is the support. If I was to go into, and inside even here on a 1 hour time frame or a 4-hour, we can see that there's kind of an intraday resistance area right around this area right here. These two spikes relatively line up, but they don't really line up the rest. But this kind of zone has some influence here for the first half of this, and not much after. So with that being said, and again, I have 1 or 2 people typing in, no sound. So what's the protocol when there's no sound? Log out and log back in. We all know this. What's the protocol when there's no sound? Log out and log back in. Instead of typing no sound, try and restart. So this context, this 4 hour and the 1 hour is going to look the same, all lines up with this. So again, the greater the number of levels that support, or the time frames that support the picture, the more confluent the level is. On a 1 hour chart, this has less confluence because it's not on the higher time frame. It's not, on a daily chart really registering, but it is kind of on a 4 hour, and a 1 hour, this has some relevance. But it doesn't have as much relevance. It doesn't measure up as well as accurately with the 4 hour and the daily. So we have to consider this more a minor support and resistance zone. And that means it has a lesser probability of holding. So it's important that we understand the more the time frames that agree with us, the better. That should be a pretty straightforward principle, yes? Yes, no? You guys still there? Okay. Okay, great. Let's get into the third one. So, number 3, there are some key levels and zones, which are what I'm going to call LLTs. Actually, I'm still deciding whether I want to call it LLTs or ALTs. Alt sounds a little strange. What does limit level trade mean? It's an automatic placement of the trade at that level. We're placing a limit order at that level. So there are some key SR levels which we want to just place our orders there regardless. Now we're going to discover that 80 to 85% of the time they are with trend, and they are always supported by higher time frame context. If you notice, when I talk about I'm placing my order here, or hey, I'm looking to buy or sell off this level, it's always supported by the higher time frame context. 80-85% of the time it's with trend, and it's been well respected, and it's probably had a strong reaction off of it. It doesn't have to have a strong reaction off of it, but having a strong reaction off the level is a positive factor. It's a positive factor for confluence. Why is that? Because when the market reacts strongly off a level, going back to our Euro-dollar one, that communicates a large amount of institutional interest. The only way you can get a strong reaction off the level is if there is a lot of order flow behind that particular level. So it's important to understand this. Again, some levels are always key levels, or LLTs, that we place orders on. They're automatic. They are 80-85% of the time with the trend. They're always supported by higher time frame context. They should be well respected, and they should, or ideally, they have a strong reaction on it. Now, Carmen has the question, how do we relate that to the 5 minute? Do you have to wait for the SR levels, the support resistance levels of the higher time frames? Carmen, we've already answered that question. You're not. What am I saying right here? Supported by higher time frame context. So we already have higher time frame context and alignment. Doesn't matter whether it's a 5 minute or 1 hour chart. We wouldn't be placing an LLT unless it already is supported by the higher time frame context. So that means we wouldn't take an automatic LLT on a 5 minute chart unless it already has the higher time frame context and alignment, unless it already has been well respected, which would mean for it to be well respected, it can't be just well respected on a 5 minute chart. It has to be well respected on a higher time frame chart. Does that make sense? I would think I've already answered that, but maybe okay, great. So, Carmen, do you understand that? So we're not trading a 5 minute support and resistance level in isolation. We never are. We would never, oh, this level comes on, a 5 minute time frame. Here's my support and resistance level. Here's my location. It has nothing to do with the higher time frame context. No, we always want to have it be related to the higher time frame context. Now, James has a question, should the strong reaction plus be the most recent reaction to the potential LLT? Doesn't have to be, and we're going to get into that later. That could help, but it may not mean as much. So, yes, I did like the bullet point. Thank you for that question. I appreciate the non-novel. So let's get into a couple examples of this. Let's go back to our dollar CAD because we were very active in the dollar CAD, in the course, in the forum, and ourselves. So dollar CAD, we all know, has been in a bull trend. Go back to this chart. You know, this is the bull trend. Here we are inside this corrective phase at the top. And after it hits its highs, it comes back and rejects heavily off of this kind of role reversal level here. Here's resistance, support, hits this, bounces about a couple hundred pips. Okay? So I would consider this the first, this is what we call the first touch off the level. Now, this one or this one is your second touch. The first touch, if you can somehow call it ahead of time and determine ahead of time, hey, this is where I think the market is going to stop, that means you've got your skill in place. It means you got your with trend trading in place. That the first deep pullback, you're able to call the level of where that first touch and where the bulls will say, you aren't getting past this, we're going to keep the trend going. So in some sense, this is the first touch. But in some sense, it's not. It's like touch zero. And why do I say that? Because this is the first pullback where the bulls are saying, we are drawing the line in the sand here. And so, in another sense, this is the first touch. Because it's after they've determined, said, here, this is it. This is the first return. I shouldn't say first touch. It's the first return back to the level. For all intents and purposes, I'm going to say this is the first touch. And this is the first return, or second touch. So, with that being said, this second touch, to me, is generally an LLT. We have a clearly defined higher time frame context. We have an intraday context on a 4-hour, even a 1-hour chart. This is going to look the same, where this level has been rejected before, and it did it quite impulsively. Bounced, boom, 5 bars of straight buying. That's 20 hours or 16 hours there. Obviously, a strong amount of buyers came in here. So to me, this is an automatic buy. In fact, every one of these is an automatic buy, and we just kept saying, if you noticed in the market commentary, we kept saying, buy in the zone, 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 until that zone was broken. And as soon as it was broken, we weren't saying buy anymore. To me, this, all are LLTs, limit level trades. I may have to change I'm still not totally sold on LLT, so if we can come with another kind of 3-letter thing for it, because I want to start creating a language, for impulsive, corrective, volatile, and volatile. So to answer Nikos' question, yes, this second touch is our buy order. And we're not waiting for the touch before we say, do we buy? We are saying we're buying at this level because the market has already reacted to this level before. I thought about LOL, limit order level, but they can get confused with the lots of laughs, so I didn't really feel that. Austin's saying LTO, that's not bad. I might have to, there's a way I can test. SAF, nah, because that's not quite accurate. So, LBT or LST, that's not bad. Limit buy trade, limit sell trade. LOT. If I had of the ones so far, I like Austin's LTO, limit trade order, or the LBT, LST. I'll have to think about that, so let me test in those. So, but in my book and how I approach this, every one of these is an LLT. Okay, so does that make sense? Trend level entry, no, that's trend level entry isn't, yeah, because it might not be with trend. So, yeah. Okay, so let's get in the first few questions. And let me scroll up. Okay, David has the question, how do you determine your take profit inside the range? It's a great question. So inside of a range, you generally see two kinds of ranges. You generally see, but the first one is a little more rare. It's where the market will just ping pong between these levels. The more common range is like this. These will be the major lines in the sand. It's where the order flow is lining up on both sides of the market. But sometimes it won't make it all the way. It could be 50, 60, 70%. And usually the market will start to define, hey, where's a high probability target? And that's what we have to be thinking about. What is a high probability target that the market is likely to make? Let's say you got in here. Let's say you got in early. Okay, great. We can feel pretty confident that this is a high probability target. We don't have much of a history to work with. The ideal situation is in a range, it makes it to the other end of the range, but sometimes it's not going to do that. In fact, a lot of times inside ranges, it won't make it the full way before returning back to the level. A lot of times it'll do 50, 60, 70%, come back and keep retesting this, and then every now and then it'll make it to the other side, and vice versa. Sometimes the sell-offs won't make it all the way back. So we have to think about it, okay, in terms of take profit, what's a high probability target for us? I would look at that as this is a high probability target. And so that would probably be my target. Would it be my full target? No, because I would still be anticipating that the range is likely going to hold. So with that being said, I would of course be ecstatic if it makes it all the way here, but I'm looking for a high probability target. So with that being said, that is what I'm looking at. That's how you want to determine it. And you have to look at history. The good thing is that as this thing continues, we have more of a history. We can say, okay, this is definitely a very high probability target. Every bounce has made it this far. So that could be my first. We can say, hey, I might want to hold a second lot for it to move to maybe this target here. It's not as high probability. It's a lower probability, but it's a decent shot. Even on these bounces, same thing. So high probability targets based on history, medium to lower probability, much lower probability. So what happens when we get to here? Same thing, same playbook. We'll get into a little bit more later as to determining whether you want to hold or not, but all of these from here on out are what I would consider LLTs. Does that answer your question? Colin, an LLT is a limit level trade. So, okay. Gills is saying, how many positions would you open each time? I would, in most cases, open enough lots, and that's going to vary for you. So I can't say how many lots for you because that will depend upon account size and position sizing. But I will always open enough so that if the thing does go for a greater portion of the range, that I can take advantage of that. Now, we'll get into managing and things like that later on. That's another lesson. If you want to just do all or nothing for your high probability target, it's totally fine. You can easily get a +2, +3, +4 R out of this. So hopefully that answers your question. Apex is saying, how high above the level would you be willing to get in? The fourth and fifth are a bit high. We'll answer that in a later slide. It's another tip. So let me save that question for later. Ian is saying, is the bounce at the same support level prior to the first not being considered as the first? Is it a corrective move in a non-volatile trend? Is the bounce at the same support level prior to the first? You mean this one here? I'm assuming this. Okay, yeah. Not being considered as the first. It is a corrective move in a non-volatile. By and large, yeah. Because we'd already made a new high and we hadn't had a deep pullback. This was the deepest pullback in the move. And so I would be looking at this like this is just a minor pullback, but this was a great indication ahead of time of potentially a landing zone for the bulls to say, let's get back in. But I still wouldn't consider that because we had made a completely new high. So I wouldn't look at this as the first touch. Hopefully I answered your question. David says, after the first 3 hits, the level goes higher than next 2. How do you account for this, or do you now go from the exact line to a zone at this point? We're never, in most cases, we're not looking at it as a single line in the sand. By and large, we want to look at a zone. We'll address that. Your question is similar to Apex. We'll address that later on in one of the slides. I'm not sure which one. Fuad is saying, how will we know it will break soon? We're going to answer that one later, but try not to approach this in the perspective of how will we know it will break? You don't know. And a lot of times the signs that it may break won't be accurate. In fact, in some sense, some of the signs are designed to be confusing. We'll get into some more higher probability signs, but at the same time, we don't want to approach support and resistance levels as how will we know? You will never fully know, and trying to know is the wrong perspective. We want to look at it more from what is the probabilities, not know. So it should, the question should be, if the mindset is there, the question should be, okay, what things are in place that would indicate a higher probability chance it will break versus a lower probability? That, do you see how that question is different from a mindset perspective? Yes, no? I will address some of this later. But it's important that we understand the difference in the mindset. Okay. Jack is saying, out of interest, what percentage of my price action trades are LLTs? Probably between, and it's going to be a range, you know, because it depends upon context. I would say between 50 and 75%. Golem says, do you use volume in Forex? No, because there's no aggregated volume thing out there. Everything you're seeing is, all these volume things are really broker dependent. Nobody has aggregate volume. You can get some aggregate volume if you're trading directly with EBS or Reuters. You need a prime brokerage with that. We're actually in talks with a couple prime brokerage companies. Generally, you need on the very low end to get prime brokerage, the absolute bottom, and even then there's very few prime brokers that do this. You need 1 million. Most of them require 10 just to even qualify for prime, and a huge majority of them, the mean, are between 20, 50, and 100 million for prime brokerages. When you have that, then you can, through the prime brokerage, get access to the EBS platform or the Reuters platform. And those are the interbank dealers. Those are the two ones. And they specialize in specific pairs. So if you're more likely to trade some pairs, then you would want to see if you can line up with EBS or Reuters based on which pairs they specialize in. So that would be the closest, because when you do have access to their platform, then you are getting access to a lot of the order flow. But then again, some of it's going to be hidden. Some of it's going to be, and a lot of it's going to be, or almost all of it, I think, is anonymous. If I remember correctly, most of it's anonymous. Some of it's going to be icebergs. Some of it's going to be HFTs that are manipulating it. So even then, you're not going to be getting full accurate levels of volumes, even when you're working directly with the interbank market. So hopefully I answers your question. Okay. Let's see. Menko's saying, how do you determine you buy zone for the third and fourth buy limit? That's the same question as the others. We'll address that shortly. Arash is saying, what 3 time frames do you use for your trading style in order to get a high RR? I don't look at high RR in terms of time frames. And I've said this before, the 4 time frames I'm using are daily, 4 hour, 1 hour, and 5 minute. 1 hour and 5 minute for intraday, daily and 4 hour for higher time frame. That's how I'm approaching it. So, but I don't look at saying, oh, I'm only using these 3 time frames to get a higher RR. I can get a higher RR in any time frame. It just depends upon the context, my entry location, my stop loss placement, and my take profit. That can happen on any time frame. Okay, Nikos is saying 3 and 4 hits are horizontal. It's not risky to buy then sell a breakout. 3 and 4, I can't read that thing there. are horizontal, it's not risky to buy, then sell the breakout? No. Why is it risky? What is risky in this? What? I'm not sure what you're saying specifically, so perhaps you can qualify, but how is there risk in this? And what is the risk? It's a -1R. Now, if you're talking about higher probability or lower probability, we don't have anything in this scenario that's saying the probabilities are worse. So hopefully I answered your question. Okay, James is saying with the 20 EMA pre-breakout squeeze at the top of the range, would you have considered a breakout? Possibly. Sure, absolutely. Why not? Leon has a good point. If there is no sound, which those who have no sound wouldn't hear this anyways, but click on the globe on the control panel and check if it's in English. It's a very good point. Victor's saying, do you still look to add on to the position intraday within the range? Generally not inside of a range, generally not in the middle, because that's where, the middle is where both sides are going to be agreeing on the value. Here, there's no agreement. Or there is, the bears are saying, we don't want to be in the market, so they're kind of agreeing that it's okay if you push. And here, they're saying, sorry, we don't think there's any value here, it should be lower. In between is not where you want to be fighting. If you were to look at the order flow on a range, the least amount of activity is happening right here in the middle of the range. There'll be some around here and here, but by and large, most of your orders are going to be coming in around here and here because the institutional players know that's where their highest R potentials are, and that's where the other players are lined up. But generally not inside the middle of a range. Dave's saying, then how do you automate the trade? Do you mean like, I'm not sure what you mean by automate. Perhaps you can clarify. Okay, Chris is saying, one always has to keep in mind that the banks are very often manipulating the markets against retail traders. Yeah, they're not manipulating it by going for you. They're manipulating it. It's the wrong mindset to think that a bank is going to try and move the market to take you out. All the retail traders combined on any given day are barely 10% of the market. But that's spread across 30 plus pairs in several different time zones. So on any given time zone, the retail market is at best 3.5%. If we weight it towards Europe, it's about 5% of the market is involved during the London session, 3% in New York, and then the rest is Asia. But then again, that's still spread across 30 pairs. Now, within that 5%, about 40 to 45% of the trades will be on the euro dollar. So at best, of all the orders in the market, the retail market will, on one pair, will only comprise 2.5% of the market. The institutional market, which is combined 90% of the market, isn't going after that 2.5%. It's not worth it to them. You wouldn't do that either. If you are, and this is the analogy I like to use, if you are a lion on the savannah, you do not care about that small little mouse or rat. You are looking for big game, and you're worried about big game that could potentially threaten you. That's where the payoffs are. Could a lion feed itself off on rats? Yes, but they'd have to find a shitload of rats, and they have to work really, really hard and spend a lot of energy to get all those rats just to get the equivalent of what would be a meal for days in one catch. So that's really not... institutional market isn't really looking for the retail market. You wouldn't be doing that either. Just like, yeah, it's generally not how they do it. They are manipulating the market. They're moving the market. They're playing against other players. It's a different field. So hopefully that makes sense. Nikos is saying, can we use volume to understand volatile or non-volatile trends? Again, you can, but it's only going to be aggregated for your broker. So it's a limited amount. Leon's saying, what leverage do prime brokers offer? You can have prime credit relationships, so you can trade on credit with them. You can trade with a prime broker. You can You can not just be trading a position, you can actually be the counterparty to people. In other words, you can say, hey, I'm selling 10 million of this currency at this lot, and you're doing it because you think that that's going to be very valuable to you. You can offer liquidity. You can actually offer liquidity to people. So you can work directly with the interbank market liquidity providers, or you can work as an individual trader or fund saying, I'm going to take this side of the position, who wants it? And so then you can be trading one-on-one with somebody. So there are certain advantages. But again, unless you have that 10 million, it's really kind of a speculative question now, isn't it? So David's saying, I'm confused because on the Euro chart, you were adamant at getting at the level, but on this chart, the level changes. So if you're waiting for price to come down to the level's not changing here. This is the dollar CAD chart. Here it is on the daily. It's the same. This box is the same levels as here. There's nothing different. It's the exact same box. So there's no changing. That other chart was euro dollar. This is dollar CAD. Here's dollar CAD on the daily. Here's dollar CAD on the 4 hour. This is the exact same box that has been drawn. But we'll talk about zones. Again, I've said I'll answer that later. Okay. So it's not a good idea to trade in the middle of the range. Generally not my favorite. Understand it's a lower probability trade. So lower probability means there has to be higher reward potential available for it to make it worth. Otherwise you lose an edge now, don't you? See, is the number of touches affect your decision when trading in SR level? Doesn't have to. I'm more concerned with history. I'm more, again, number of touches could be a positive or it could be a negative. Shoot from surprises levels. I'm not sure I understand that question. Is it correct to count the range touches? And if so, how many is the list to create a non-volatile trend continuation? Well, first, before we can even have a non-volatile trend continuation, we have to clear the range. And I wouldn't consider again, I think I've answered this in the last question, counting the touches really isn't, it's not really effective. It doesn't really matter. Price doesn't come down to the level in the 4th hit. Yes, Dave, and we'll answer that regarding zones. Again, support and resistance levels and never pure lines in the sand. They're more often zones. We will get into this, though. I promise that. I've said that, but maybe you didn't hear it because you came in late. Okay. Rich says, I think retail traders are important to institutional traders as a gnat on an elephant's butt. Pretty much. And no worries, Colin, you're just trying to get in. So, Ian's saying the middle of the range is a weak hand. It's a lower probability hand, yes. So you better have a high R potential on that to make it worth it. Okoye's saying, do you consider bank holiday as the major currency not to enter setup of the pairs on a level? That's a question. Yeah, whether it's a level or not. Yeah, let me answer that later. That's kind of more of a miscellaneous question. So after we've gone through all the slides, let's re-address that question. Okay, so then re-ask it. Question. More touches. Wait to recording. Let's see here. Blind zone question. I heard it, but you were answering my questions like 2 minutes off. Sorry. Not judging. I'm sure there's lots of questions, but I'm answering when you talk. But you don't read my answers for a long time. Yes, because there's a lot of other questions coming at the same time. Okay, let's see. I think we're at the bottom of the questions, and I'd like to move on. Are you basically trying to get a buy order in as close to the bottom of the red line as possible, depending upon your RR tolerance? Some people will be happy to wait for price to get 20 pips above the support line. That's a zone question. We're going to get to that in a second. So great question. All those questions seem to be around the zone thing. So let me get into a few more examples of this, and then we'll address that. Before we do that, give me 1 second. I have to take a loo break. I'm going to leave sound on. I'm going to shut the door and go down. But yeah, so let me just take a 2-minute break, and I will be right back. Okay, I am back. Thank you for allowing that. That was well needed. All right, so let's move on to the second, because remember at point 3, which is talking about automatic LLTs, 80 to 85% of the time, just to recap, are with trend, always supported by higher time frame context. They should be well respected, and a strong reaction is a positive confluent factor. Now, another example of this was dollar Swiss, and we've talked about this inside the commentary as well, about buying the dollar Swiss. So the dollar Swiss had the sell off from the SMB, then it rose back up to just about parity, and then it started to pull back again. So on a higher time frame context, we're kind of in a mixed bag of things. This zone right here is in the middle of the top of the SMB moment before they sold and the bottom of where it ended up when they were done selling that day or removing the floor. So we're kind of in a mixed bag. We are short-term in a bear trend, medium-term we're in a range, and long-term we're kind of in a bearish, but that's kind of a mixed bag. So we're kind of neither in a bullish or bearish. Now the market has its first push off of here, and so it kind of establishes this is the first major pullback in this sell move, or decent one. And it's extended, it's continued. It continues for several days. So the buyers kind of say, hey, this is a level we are going to try and defend. This really would have been your first opportunity to get into the market. Now, with that being said, would this be aggressive? Yeah, it would be. I would still be open to taking it because of the 250 pip reaction off of it before. This would have been a little intimidating, I'll totally confess, but I would have been open to taking it because you don't need a huge stop, and if it moves at least the 250 pips, you could have a very high profit potential trade in here. But let's say you want a little more information. Well, then this is your next opportunity to get back in. And look what happens. It pushes it past 250 pips. It pushes like 350 pips, maybe more. So this could have been your first opportunity, or this could have been your second one. But all of these subsequent tests, to me, are LLTs. They're automatic buys. The only difference is that we notice the reactions start to get smaller and smaller. So what does that mean? History is telling us, okay, after this bounce right here, and it comes right back, the next time around, if you're looking to get in here on an automatic trade, this should probably be your first target, and this is what you should be looking at as a high probability target. I actually bought this and this. I think we even mentioned in the commentary, hey, this is a key support level, keep looking to stay long until this thing breaks. What I did notice is that since the reactions were getting smaller and smaller, I said, okay, I need to have a tighter stop for this to make sense, because I'm estimating that this is now where it's going to get to. Overall, this communicates potential breakdown, but is there still potential trade opportunity here? Yes. 1, 2, 3, 4, 5, 6, 7, 8. Maybe even this is 8. 8, 9. So even by this touch, I was still buying it, just understanding, hey, I'm only probably going to get 60, maybe 80 pips out of this. So if I want a high probability 2R trade, I need a 30 or 40 pip stop at the best. So this is another example to me of an LLT. Alistair's saying, Chris, would you take that 4-hour dollar Swift chart at face value, or do you look at daily to check if this was a key level? If it was showing up on a 4-hour, showing up on a daily, to bounce over a month off the same level, it's still showing up on a daily. Would I take it at face value? I'm never looking at one time frame in isolation. I'm always looking at the higher time frame and the lower time frames. But to me, this is an example of an LLT. Now, Daniel's saying, dollar Swiss, were these LLTs not counter trend trades? In this context, yes, they were. But 9 touches is pretty strong, and that's for something to react off of a level 9 times in a month tells you there's at least enough of a presence of the bulls to offer a trade opportunity. Should we be looking for trades in the direction of the trend? Again, I said the trend was a mixed bag now, wasn't it? Yes, it was selling off and then hit here, but it also was in the middle of that whole top to bottom range from the SMB. So I looked at it as a mixed bag of things. Okay, and Mikkel, I think I've answered that question about it being counter trend. So hopefully I answered your question. To me, I would look at this as an LLT. Again, 80 to 85% of the time they're with trend. That doesn't mean it has to be with trend. If it was, I would say 100% of the time. Not all LLTs are with trend. Great example, Eurodollar. In this context, this resistance is kind of against the bullish pressure. Yet we were selling every single time. The long term supported this, but short term and medium term didn't quite support this. Yet we were selling. After this, it became an LLT in my mind. And that's why we said, look to sell here. And that's why we said again, look to sell here. A couple more examples of some LLTs. So you can kind of see it in a different context. What's the context here? Bear trend with a range at the bottom of the bear trend. What does a range at the bottom of a bear trend mean? Nobody answering? Okay. Yeah. Most probably is going to the downside. So if this range was, say, a little bit tidier like this one, we can still play both sides, but our bias is always more towards with trend. So let's say there was equal amount of touches on this range on both sides. Let's say there was 6 at the top and 6 at the bottom. We'd still want to be placing more of our trades with trend than counter trend. And so same thing is here. This range wasn't quite as defined on the downside. The downside was a little bit messier. But if we look, what do we have? We have a context of this holding here. It's a roll reversal level. So boom, boom, makes a new low, roll reversal level. If you weren't selling on this first pullback, you should have been here. It should have been an LLT. Same thing here. Same thing here. Same thing here. But we are paying attention. Hey, the bounces aren't making it down here. They're only making it down here. So this is our high probability target zone. Now we break through it. We reject, hit it again, reject. Okay, so now we have 2 areas. We have one large zone, but we have 2 areas where we could be potentially placing LLTs. Again, it comes right back to this. Bam, bam, bam. All LLTs. Here, if you're waiting for the confirmation pin bar, your entry at best doesn't come till here. You're way away from the order flow. Same thing, LLT. Break through it. Okay, great. We're stopped out for a -1 hour loss. We made money here. We made money here. We made money here. Consider selling again at the same area. Maybe you get stopped on this one. Second pullback, fine. I'll sell it again. So this would be an example of another type of or series of LLTs. Make sense? Yes, no? Okay, good. Let's see here. Okay, Gabriel's saying on the Swiss before 2. I don't see previous rejection off that level. It's right here. So that's where the previous rejection was. You just somehow missed it. Okay, Gilles is saying, after a breakout, what to look for? Use the first level again. Well, if a level has been incredibly strong as resistance or support, what's the most probable scenario that level is going to be on a breakout? It's going to most likely become a roll reversal level. So we still watch that level. If it's been important to the buyers or sellers on one end, when it gets broken, then it becomes a high probability roll reversal level, or an RRL. Okay, Mohammed's saying, what is the difference between SR and a key reversal level? There's no difference. Support and resistance is just a zone or a level where the market reacts or responds to. Key reversal level would have to be one of those. Nikos is saying the 20 MA is lower from your lines. Lower from your lines. Is this a fact that the sell line is strong? The 20 MA in a range really doesn't mean much. 20 MA only really is useful in a trending environment, so we pay less attention to it during a range than we do in trends. Tommy is saying, when do you think the zone is broken? Well, I think this area, this is kind of a zone in and of itself, so let's call this a zone. Let's call this a zone individually, and then this whole thing is a zone. So there's a minor zone here, resistance zone here, there's another one here, and this whole thing is a giant resistance zone. When would I think it's broken? When the market then all of a sudden does a roll reversal level off of it. Closes above it, starts treating it as the opposite direction. Okay, Okoye says, Chris, do you set your limit order exactly at the level or a little below the level if it's a sell order? Let me answer that question in the zone. The zone slide tip. Because it will tell you how to relate to these things. Daniel's saying, Dollar Swiss, should we wait for history confirmation on lower time frames if the higher time frames are against our... Should we wait for history confirmation on lower time frames if the higher time frames are against our counter trend trades? Anytime you're trading against the higher time frame context, you want a greater amount of confluence. So let's say we are in, and let's use this as an example. Or let's use, doesn't really matter. Let's say we're in a bull trend. Let's say we're in a bear trend, but we're wanting to buy. We're going to want as much confluence as possible to support that. Why? Because counter trend trades, by definition, are lower probability trades. So to augment that, we need as much confluence as possible, and that would mean intraday, we better be really supported by the intraday. Also, we want to have a higher probability R trade or higher plus R trade available. It's kind of like, and this is why I recommend playing poker, because, for example, let's say somebody raises pre-flop pretty strongly, and pre-flop is we hand you your first two cards, but we haven't put the flop on the table, which is the first three cards. Let's say somebody raises pre-flop and you got a pair of pocket twos and they raise pretty strongly. And then maybe somebody else comes in and says, okay, I'm going to call that. Well, then that probably means that at the minimum, one person's got a strong hand and maybe two people got a strong hand. So for us to be able to want to get into that, the profit potential has to be high because we're already in lower probability that we're going to make money on that hand. And the same goes with trading. So that means there has to be a lot of money in that pot for us to say this is worth it, because otherwise we're going to lose this trade, out of 100 times, we're going to lose a lot. So the money we make on those wins has to be a lot for it to have a positive expectancy. If it's not, it's not worth it. So if you're trying to trade counter trend intraday, you better have a lot of intraday context supporting you. If you're trading against the higher time frame context and you're trading intraday and you want to, buy in a bear trend or sell in a bull trend, the intraday context better be supportive and it better be a high R potential trade. A plus 2R, it better be like you feel 70, 80, 90% that you're going to hit that. Otherwise, it's just not worth it. It should be like 3, 4, 5, 6R because you're probably going to lose a lot of those intraday plus 2R trades. But if it's 3 or 4 or 5 or 6R, now you can get a positive expectancy out of it. So hopefully that answers your question. Okay. Gills is saying, do you wait for it to retest the first level again? No, because this is a roll reversal level. We have a clear roll reversal level here, so I'm selling the first time around. I don't. If I have a clear RRL, no, I don't. If I don't have a clear RRL, I'm going to want to see the players in this area define where they're saying, sorry, you're not getting past this. Once they have defined that, then I'm interested. June is saying, would you place a limit order next at the next support? I'm not sure if you're talking about the Aussie dollar or something else, but perhaps you can clarify. Just above the next line you drew. I only see two lines on this here, 79.07 and 78.50, so perhaps you can clarify. Okay, Chris is saying, what happens in an order flow perspective when a support and resistance level becomes a role reversal level? That's a great question. So let's kind of paint a picture here. Let's say we got a bull trend and we make a new high, but then we pull back from that high. And let's say we pull back to a prior support level. It depends on how that level becomes an RRL. For example, if it's a, like this one here, bounce, push, comes back here, we're going to have a fair amount of bears who are going to say, yeah, I think this is going to hold. Bulls really aren't going to be activating any orders here. Bulls that had bought here are probably going to be exiting their trades as they head into this level. And new bears are going to be coming back in. But let's say it's a pre-breakout scenario. There's going to be a lot more order flow around that because there's players constantly in and out of the market until the actual break happens. And there's a lot more stops being tripped. And stops being tripped tends to activate a stronger response from players than a limit order being hit. So, you know, the studies are clear on this. If the market hits my take profit level, I am by default less likely to re-enter the market. But if a market hits my stop level and I'm a professional trader and I'm comfortable flipping from long to short, short to long, well then, if I get stopped out and I see that there's a pre-breakout scenario and the market's switching directions, there's a much greater chance that I'm going to re-enter the market in the opposite direction. So it depends upon the order flow around an RRL is going to depend upon what is the context leading up to that. Did an RRL become an RRL through a pre-breakout scenario, or was it something like this? Something like this is going to have less order flow versus a pre-breakout scenario when both players are actively involved in the market until the market's taken out that level and taken out the stops. So it just depends upon context. Carlos is saying, do you believe that the way in which price arrives at the level, put context by looking at the aggregate info of the range, will dictate where to set the stop loss? Not so much. We will address that in the last slide. Okay, Menko's saying 2 touches on the lower, 1 on the higher, and again 2 times on the lower and 1 touch on the higher, a coincidence. I don't necessarily look at it that way. Maybe. Hi Chris, I get confused about this. Can a return to the 0 line setup become a role reversal level? Absolutely. Why not? Of course it could. James is saying, are you covering the stop loss placement in the zone section? Yes. Steve's saying, so volatile or non-volatile order flow leading up to a level is not a key consideration when placing LLTs. We addressed that in the 10th slide. Victor's saying, would you consider buying off 78.50 RL and 20 MA once it got broken after the second box? Possibly. That's a tricky one. I would probably consider it, but then in the face of this, I'd be like, uh-oh. You know, that just doesn't make sense. For it to, you know, it breaks it, comes back here, bounces impulsively, but next candle does a complete 180. That's not how strong roll reversals RRLs generally function. So, you know, after that second one, I'd be like, that doesn't make any sense. Leon's saying on Aussie dollar, would you be really selling at the first touch, the first reversal out, because it came after an exhaustion bar and pin bar? Again, in the context, what are we looking at? We're in a bear trend. We have a level that the bulls come in, we make a new low, so that means that there's a high probability that this will become an RLL. So yes, I will sell on that first touch. Absolutely. Sometimes this is your only entry before it makes a whole new level. You know, sometimes the market will be like this, except this pullback is to an RRL. A lot of times the market will do So that first RRL touch is sometimes the only touch for that move. So yes, I will. And again, I'm not really worried about it because it's a -1R. It's still a high, and it's a -1R in the context. Going back to point 1, it's all supported by the higher time frame context. Okay, Chris is saying, is the double aggressive candle like in the first and the third box a good signal that this is an RL? I'm not sure what you mean by double aggressive candle. I don't understand that terminology. That's not a language I used before. So, but we will get into strong reactions off of the level. Okay, I want to give one more example of an RRL. Or an LLT. It's Kiwi dollar. Kiwi dollar has been in a bear trend minus kind of a choppy corrective style range. This was resistance, then it made new resistance. We've got a pretty decent reaction off of here. Would I consider this an LLT? Yeah. By and large, yeah, I would. Because you could have a tight stop and your first high probability target is, 90 pips. Could I get away with a 30 pip stop by getting in at 77.34? Yeah, absolutely. If it wasn't an LLT by this time, then this time it was an LLT. And this time it was an LLT. So, yes, I would consider this. If it wasn't by this time, it was by this time, without a doubt. So these are 5 examples of LLTs. All right, we spent a lot of time on that. So, and there's still some questions in the queue, but I want to answer some of these later because they will be addressed later. So let's get to number 4 because we're already behind schedule. Number 4, intraday context can and often will contradict higher time frame context, which I covered in the third video in the first section about understanding intraday context versus higher time frame. So this is kind of a repeat, but it's important to understand. Intraday context can and often will contradict higher time frame context. If we are trading intraday context against the higher time frame context, holding time should be shorter. Now this should be pretty straightforward because we've already covered this, but let's go over a couple examples. This is important. What's the higher time frame context? Bull trend, range inside of, or at the top of the range, means most likely bullish continuation. So we want to be buying more than selling. If we want to be selling, we want it to be a high probability or high profit potential trade. These are your major zones, major support and resistance, and we have a minor one that really doesn't show up till about here and here, and then here and here. Let's look at this thing, this minor support level, and let's look at the intraday context. Let me just make sure, 1860. Okay, this is the same level, 1860.08. This is that same support level. Look at the intraday context heading into the level. It's completely contradictory to the higher time frame context. Yet the higher time frame context holds. In fact, almost every time, this time no, it's corrected pulling into the level. It's a little corrected, but look at this. Again, impulsive heading into the level, level holds. There will be, even this time here, one massive bar impulsive move, level holds, zone holds. Oftentimes, the intraday context can and will contradict the higher time frame context. And yet the higher time frame context will still hold. That kind of goes back to point 1. Higher time frame context is more important than intraday. That's why, since this happened, we've been saying, hey, this is your support zone. Look to buy, look to buy, look to buy. And it's bounced every single time. This time it didn't quite get there. But I would buy here again. 9 times out of 10, if it gets back here, I'll buy it again, unless something is just screaming every alarm bell in my brain and pattern recognition software, in my brain. Unless it's all screaming, do not trade this, I'm gonna buy it. I actually have a standing resting order waiting here because we've made money on it several times before. It's important to understand that. A lot of you have been asking, well, what happens if it heads into a level impulsively? It's a pretty damn impulsive move heading into the level. And it holds. Have to understand that. Number 5. The first test, and we have covered this before, but I want to re-emphasize it. The first test of a key SR level generally offers the best trade opportunities. Why is that? Because institutional players are generally the fastest people to the market. They need the least amount of information to make a decision. They have confidence in their ability to find good trading locations. They are more likely to play off that first touch. Every subsequent touch generally reduces institutional interest while bringing in more retail interest. It's not always the case, but if the market keeps touching it and the rejections get smaller and smaller, you can believe and you can bet that institutional interest is dwindling while retail interest is increasing. So that first touch generally offers a high trade opportunity. Benson's saying, what if the daily and 4-hour context contradict each other? Then we go with the daily. When in doubt, or understand, if you have to choose, if you have to approach it as an either or, we go with the higher time frame. That doesn't mean you have to choose it as an either or. They can and often contradict. Daily to 4-hour can contradict, 4-hour to 1 hour, 1 hour to 5 minute, they can contradict. Just understand that time horizons change based on the time frame. A move on a daily chart is going to probably be larger and take longer than a move on a 5-minute chart. So if your daily and 4-hour contradict, if you're only approaching it as either or, I'm only going to do either or, then you go with the daily. As your skill level increases, that either or mentality will blur because you won't be thinking in either or. You'll be thinking more of if then. So you can be looking at it as, okay, I'm interested in this 4-hour even though it contradicts the daily. So I'm going to buy it if it does this. And if it doesn't do this, then I'm going to revert back to the 4-hour. As you progress in your trading, you'll stop looking at things as either or and you'll start looking at things as if then. Chris is saying, what kind of pattern recognition software do you mean? I wasn't talking about software. I was talking about my brain. I don't use any pattern recognition software. I use my brain. It's the most powerful computer on the planet. There are more cellular connections and synapses in my brain than there are stars in the universe. Sorry, let me put it to you this way. I have about 100 billion nerve cells, just nerve cells. And then I have, I think it's like 100+ trillion or 1,000 trillion different neural synaptic connections. Each one of those 100 billion cells can have anywhere from 1,000 to 200,000 different connections. I have more of those connections than there are stars in the universe. The brain is a very powerful computer. That is my pattern recognition software. So that's what I was talking about, speaking figuratively. Mohammed saying, after the higher time frame support or resistance is broken, when can we determine that this break is not fake? I mean, after how many candle? The number of candle won't determine whether it's fake or not. We can't look at it that way. Well, we can look at it, an RRL is generally a communication that the market, the order flow is changing sides. We are no longer considering this resistance, we're now considering it support. That's a sign that the market is changing. Pre-breakout scenarios that's why they're called pre-breakout. They are communicating of a probable outcome and change in relationship. So hopefully that gives you an idea. But don't think about a number of candles. It doesn't work like that. Okay, so a couple questions, and then we're going to move on to some examples of this. Alistair's saying, so the dollar CAD raging example, if you are cautious and looking for the highest possible probability trade, just focus on the first touch? No. It's just saying the first test of a key SR level generally offers the best trade opportunities, and that is more applicable in trends than in ranges. In a range, ranges are generally sustained, so the support or resistance level is going to hold often. Inside of a trend, that first pullback to a key SR level, especially if it's an RRL, generally offers the best trade opportunities. But in a range, which was the dollar CAD, that's not the case because a range sustains. So we have to understand this is more talking about in with trend environments. In a range, the first or the fifth, it doesn't really matter. That's the whole definition of a range. It's going to stay inside that until it breaks. So until it breaks, both sides are applicable. And then the first touch isn't quite as applicable. So this is more applicable to in with trend context. Victor's saying, if you put your stop loss to break even after reaching your high probability target and then it reverses and you get stopped out, would you immediately enter again with another order on the level? Yes. Although I will say as a whole, if I'm up plus 2R, I'm not walking away from that trade. Most often I'm not walking away from that trade without any profit, because the only time I will walk away with that trade for zero profit is because I'm looking for like a 7, 8, 9, or 10R. Why is that? Well, let's look at the mathematics. Let's say I'm up plus 2R, but I'm really only going for plus 3 or plus 4R. What's the mathematics behind it? Well, if I leave the trade to run, and I'm at plus 2, and I'm going for plus 3, if I don't move my stop to break even, I'm still risking 2 to only get plus 1 more. In fact, in some sense, I'm risking 4R because I already have 2 in the bank, or at least available at that moment right there. So I'm risking the 2 I have in profit plus the 2 I have in risk to gain 1 more R. That doesn't make sense to me. Doesn't make sense to be losing when I'm up plus 2R and I'm only going for a plus 3 or plus 4. If it's a 6, 7, 8, or 9, then it makes sense to leave the trade open and not adjust the stop to break even. Same scenario. Let's say I'm up plus 2 right now and I'm going for plus 3. What am I doing by moving the stop loss to break even? I've neutralized 2 out of the 4 risk on the table, only to gain 1 more R. So that still leaves 2 risk open, because right now I can close the trade for plus 2R. So I still have 2 on the table, only to gain 1 more R. That's not really, to me, that doesn't make any sense. So if I am up plus 2R, I'm not walking away from that trade at break even or a loss unless I'm going for a really high probability trade. And Alistair, you're saying to be super safe, but what does super safe mean? You're still only risking 1R. And I'm challenging that question not based on the legitimacy of it, but on the mindset behind it. What is safe? Traders don't look at this and say, okay, I want to be safe. They're looking at it and saying probability. What's the probability? So it's important to understand that difference in the mind. Okay, Daniel's saying, do you mean with the first touch, the first return to 0 point, or the first big pullback in a trend? I'm not really sure what you're asking there. Perhaps you can clarify it with a little bit longer context. June's saying, would you place a limit order on the Aussie dollar resistance level just above 8? Possibly. I can't say that because that's an open-ended question. What's the context looking up to it? Is the market now treating those prior resistance levels as support? Maybe not. If it is, then again, I would need more context. It's a too ambiguous a question for me to answer that. Okay, Leon has a question. If there is a double bottom or top or 3P HLR on a lower time frame after resistance or support break on a higher TF, it's usually a false break, what I've noticed after 5 minutes. It's hard for me to understand that. I probably need some chart examples. So perhaps maybe start a new thread in the forum and then post some chart examples for me to look at that, because it's very hard for me to fully understand based on that description. Gil's is saying, would I use a trailing stop? Trailing stop on what? If you could clarify that. And by using a trailing stop loss. By using a trailing stop loss. I'll need you to clarify that. I'm not sure I understand the question. Chanel is saying, I hope you're well. I am. Thank you, and I hope the same for you. Would you say the majority of trading strategies you employ on a day-to-day basis are these SR methods? I feel as though these SR methods offer the higher probability trades. As a beginning trader, I would like to focus on these strategies that offer the highest probability. So the majority, I don't call these support and resistance strategies. These aren't, I don't call these strategies because, again, SR trading using SR levels is part of price action context. And the only thing about it is that SR levels and zones are designed to help us find better trade locations. Now, as to your intuition that do these offer the highest probability trades, the answer to that is yes, they offer a higher probability and they offer higher profit potential. But again, we aren't trading these by themselves. It's not like all of a sudden we're just trading support and resistance. No. It's price action context is first. How the market responds and reacts to levels is part of price action context. It's in the third layer of price action context. That third layer, combined with the other two layers, which is impulsive versus corrective, volatile versus non-volatile, helps us all determine trade location. Based on all those things, when you have all three layers of price action context in place, by default, you automatically have the highest probability or a high probability trade with a high profit potential trade in play. So that is by design already there. So good intuition on that. Alistair saying, I mean, just to get the percentage rate tally up. So if you know that across the board you're getting say a 65 to 70% success rate, is this particular trade helping or hindering your hit rate? Most likely you won't get a 60 to 75% accuracy rate without having context in place. So adding extra information, unless you can quantitatively show me that, hey, these are my rules for adding extra information, and I have 100 or 500 or 1,000 trade sample set to prove that this is more accurate than without these rules. Unless you can demonstrate that statistically, we're talking about smoke here, aren't we? So I'm willing to bet that your rules are pretty clear in saying, look, I'm only willing to do these things to take a trade. I'm also probably willing to bet that you probably don't have too many filters for saying, okay, I have another set of criteria to amplify the success rate. You should be amplifying the success rate from the beginning. All those rules which give you the highest probability and highest accuracy rate should be there from the beginning. Now, maybe you've created a second criteria that says, okay, I also have these extra information type trades that I'll take. And the extra information has rules X, Y, and Z. And based on this, I can compare it to my baseline information trades and extra information trades and segregate the difference and clearly demonstrate statistically these extra information trades are increasing the success rate. If you are doing that and you can demonstrate that clearly with clear rules and over 100, 500,000 trades, then you have something. Otherwise, we're talking about smoke here, aren't we? Confluence is a real thing. And I'm going to give you every single confluent factor that I find to be important, or at least the core 10 ones, in this thing. We still got 5 more to go. Confluence helps, but again, that doesn't accuracy rate doesn't necessarily determine expectancy nor profit potential. Some of my highest profitable R trades have low success rates. And if I was just to isolate those trades and put them in one account versus, say, my 65-70% success rate, it's probable and it's most likely that those high R trades are outperforming the higher accuracy trades. By default, higher accuracy trades most often have smaller targets. They'll have a slightly more stable equity curve, but that doesn't mean they're making more money. And so this is a mindset thing I'm challenging you on to see the difference. Chris is saying, going back to his example, I mean after racking in plus 2R, closing half the position, setting the stop loss to break even, then trail it. So again, if you have, let's say you have a 10 standard lot trade, and your first target is 100 pips and your second target is 200 pips, and you have a 50 pip stop. Plus 2R is at plus 100 pips. If you have 10 lots and you close 5 lots, and you bring the stop to break even, until you've closed that second lot, we can't say whether you're up plus 2R. Because the full position hasn't been closed yet. So if that second position gets closed to break even, then you're really only at plus 1R on the full position now, aren't you? Isn't that how the math works out? It would only be plus 2R on the full position sizing, not half. Now, will I do that? Yes, if the math makes sense. The only way that would make sense is if there's a lot more profit potential in play, because that first half that I closed, I've really only closed at plus 1R for my original position size. So if that second position can go for 4, 5, 6, or 7R, well then the 7R plus, let's say it's 6R, and I had 2R on the first one, that's 8R, but I have to divide that by 2 positions. So I really only ended up at plus 4R. So hopefully that explains the math. June is saying, when I say context, is that impulsive versus corrective? So June, context, price action context includes 3 things. First layer of price action context is impulsive versus corrective. Second layer of price action context is volatile and non-volatile trends. Third layer is support and resistance levels, how the market has responded to that in the past. That is all price action context. So hopefully that answers this. Okay. Now let me move on to a few examples. I only got about 45 more minutes. And so let's get into the rest of this here. Okay. So just a brief cap of this. First test is generally best in a with trend environment. Explain the institutional trader interest around that. Let's get an example of this. So we're in a bull trend environment overall, but we're inside of a range. The short and medium term context is in a range. Even inside the range, oftentimes before we define that range, that first touch is going to offer you a really strong move. Each one after that, and look at this, it's not even quite as high and it takes longer. This third one is not bad, but it doesn't get there as fast. You look at the reaction off of it as well. This almost completely reverses the selling interest into the candle. This one not quite as much. This one definitely not. This one takes several touches. This one consolidates. Inside of a trend or inside the context, I think this is a smaller time frame. Oh, so this is showing the same one here. Look at T1. Look at the reaction here. The first candle reverses very strongly. This one takes a little bit in the zone. This one takes several rejections of the buyers absorbing the liquidity before they can finally push back. And you'll find that That's generally true in most cases. So this is most important in a trending environment, but in a range environment, it can apply. I just kind of chose this as an example because it's the one that stood out the most. Yes, Colin, that math is correct. If you close half your position at 1R and the next at 2R, you got to take the 3R divided by half, so it's 1.5. So that's how the math is done. Okay, number 6. Support and resistance levels, and here we are at the zone area. Support and resistance levels are more often zones of support and resistance. The first part of the zone offers you the highest probability of entry, but the lower it lowers your R to R ratio. The middle to the end part of the zone offers you a higher R to R ratio, but a lower probability of entry. You have to decide what kind of trader you want to be. You don't have to necessarily be one or the other. You don't have to be, hey, I want to have a high probability of getting this trade, but a slightly lesser R to R. And you don't have to be, I'm okay with missing some of these, but I want higher plus R trades. You don't have to be one or the other. My suggestion is first, get comfortable with picking one of these, get familiar with it and what the difference is, and then after you've learned one, try and learn the other. So this way you have both as skill sets. Try not to think of it as an either or, but as a both and or if then. So there might be certain times where you are going to do better by trying to get the quicker trade, the one that's more likely to hit. You have a lower R to R, but maybe missing out on that trade is less profit than making higher R to R ratio and a lower probability of entry. So I'm going to show you an example, a classic example, which is the dollar-yen zone. And this is what I've been in fact, if you notice in my commentary, what was I saying both with dollar CAD? What did I say was the zone? Does anybody remember the zone I said on dollar CAD? Anybody remember? Nobody remembers? We were covering it for a month and a half. Wow, nobody remembers. I can tell you, it's in my head. 124.30 and 123 kind of 75.60. That was the zone. So what was the upper edge of that zone? The upper edge was 24.30. The bottom edge was 23.60.75. We only had one spike below, I think if I remember correctly, only one spike below 75, and that was 60. So we had to include 60, but more probability is 75. So what does that mean? It means that if you want a high probability of taking the trade, you get in at the high end of the zone. Same thing here. Here is our zone. So here's your high probability entry, but lesser R to R by default. Here's your lower probability entry, but higher RR by default. Does that make sense? Okay, good. So let's get into a couple questions here. Leon comes up with a very intuitive idea. You have to forgive me, I'm having a little yogurt here. I haven't eaten this morning. It's now 10 o'clock in the morning. I've been up since 6:30, so. Okay. Leon's saying, why not have an order at the first level with the stop at the second level, so when you get stopped out, the second limit gets triggered? I wouldn't do it that way. I would have an order at the first level. I wouldn't have my stop at the second level, have my stop beyond the second level. Because if I really have confidence on that level, then I think that level should hold. Why would I put it at the level? I want to put it below it. So I would have one here. If you're going to do that, I would have one here, and I would have one here. Now, you have to understand, though, that changes the math when you're doing it. Because what are you doing? You're doubling up on the trade. If it blows through, if it goes to the bottom edge of that zone, you're really taking 2 times the trade. So you have to reduce your exposure on the first trade and split it between the 2. If you are going to do that. Will I do that? Sometimes I will. If I'm really confident in the zone, and the zone is well defined, sure, I'll be happy to do that. But I'm going to put my first stop below the second entry area. Sometimes I'll even enter towards the middle of it, because sometimes it won't even make it here, but it can get close. So you really have to learn to play with that. That will come with time and experience. But you also have to understand the math behind it. James is saying, do you ever scale in, and do you give value to that approach? Yeah, I've done videos on it. That's my pyramiding trading videos. That's what scaling in is. I'm adding on to the position as the thing goes on. If you are talking about buying a small amount in the beginning and then seeing if that level is going to hold and then adding more, it's not really my style. I either want to have confidence in my position or not. The only way I would do that is if I'm looking for a high plus R trade. Because otherwise it doesn't make sense mathematically if I'm just going for plus 2R, plus 3R to be like scaling small amounts. That would make sense if you're doing a Livermore type approach where you're going to try and trade for a big runner and you want to give a little bit in the beginning to see if it's going to hold, and then if it starts to kind of really, if the information comes in and says, hey, this is going to hold, and then start adding on, yeah, that can make sense. But again, it would only make sense if you have a higher potential. Otherwise, you might as well just have the whole position right there. Colin has a question. If stopped out by a tight stop, would you re-enter the same direction as the first trade? It would depend upon the context. That's kind of an open-ended question. The context could change on both ways for me to say, yeah, I want to re-enter, or yeah, I don't want to enter. So it's hard for me to answer that based on the way the question is worded. Chris is saying smaller lot size on the higher probability and even bigger lot size on the second level. You could do it. You could scale it that way. Like you could adjust the position sizing. The thing about it is that there will be a lot of times where your second entry just won't make it. So that means you're making a little profit on this trade and you're making a lot of profit on this trade. But then what happens when, let's say you do a 10 lot trade here and your big lot is a 100 lot trade, but it blows through it. Well, then you took a full 1 hour loss on that big lot trade, and you only made a little bit of profit on a very small trade, a fractional size trade. So that throws off your risk of ruin. So if you're going to do that, you have to understand the R to R behind that. If you start fractioning the trades, like if I normally take a 1R here, and I'm going to take a 0.25R here, and my 0.25R profit's at a full profit, but my 1R gets crushed, well then I'm imbalancing the R to R on that. Now, in terms of the stop loss placement, it should always be outside the zone. If the zone is defined and it's got shown a pattern of holding, we don't want to put the stop loss inside the zone now, do we? So my stops on these types of trades, and I've even mentioned this. That's why I say a daily close, above or below this level would negate the context. I'm basically trying to say, hey, beyond this area, I don't want to be in the trade. That doesn't necessarily mean that's where my stop loss placement is. My stop loss placement can change upon volatility, pair, liquidity. Is this pair more or less volatile than the others? Is it like gold where you need much wider stops? Is it like euro dollar or something, or Kiwi dollar where you can have smaller stops? So I don't have a fixed size in terms of the stops, but it's always on the other side of the zone. Victor's saying, is there a counter trend pre-breakout pressure towards the first part of this zone? There is some of that here, for sure. But I have massive context in my favor. So this is a pre-breakout on a range that's held for like 2 months. If I was to go back, I can't remember exactly, but the dollar yen, this is the smaller range inside the larger range. So yes, there is a pre-breakout. And sometimes that pre-breakout can be informative. But by and large, if you notice, what's the difference in this pre-breakout versus another one? Can anybody, people are really good with breakouts, can identify this. So what's the difference between this pre-breakout and say one from my video? Yeah, so Mikkel is onto it. Bigger candles, what else? We shouldn't be seeing those kind of rejections now, should we? They're supposed to be small little candles with very small rejections now, aren't they? But yet there's constant downside wicks. So Mikolo was the one who really got it. Yeah, and Vickis is saying this one has a lot more two-sided order flow. Exactly. So, great question. Chun is saying here, if you entered long at the first blue circle, okay, where exactly would your stop loss be? It's not a set number of pips. I think I just answered that. Maybe you were typing and I was answering it. But it would be on the other side of this zone. And that depends upon volatility and, it depends on a lot of things. It's not a fixed pips, but it's going to be on the other side of this zone. Okay, great. I think I can move on to number 7. And we only have about 30 minutes because at about 10:45 I have to go because my girlfriend and I are going to brunch. We have a brunch appointment today. So, number 7, impulsive rejections and short holding times at a level are a positive confluence factor. And that should make sense. I think you can all understand that from an order flow perspective. It supports your trade idea further. So let's say you did get in a level, like this one here, and you see that there's a very strong impulsive bounce off of it and then it's hovering above it. That should be indicative that you're, most likely in a good trade. And that it's probably going to go for, unless you have a really wide stop, you should be able to get more than a +2R out of this. You should feel confident in your trade if you get a strong impulsive bounce. Even this one here, let's say you did get off the bounce. 3 candles of impulsive buying to take out the last 20. That should tell you, hey, I got a good trade here. It's important to understand that the order flow is communicating large institutional interest or high imbalance around that level. Likely indicates high profit potential move. Great example, Eurodollar, my trade recommendation. So we had a sharp pullback here, some strong rejection here. Second attack, very strong impulsive move. 2 candles jumps, 200, almost 200 pips. That's communicating very strong impulsive move off of that. So what did we do? What did I say? Here's your buy zone. What did I say? It's a zone. It's between 1070 and 1035. It went to about, 1060 or something like that? That was where my entry was. My entry is at 75. Strong impulsive bounce gave me confidence. I had a great move. What was I targeting? The other end of the range. I felt like this area was my target, and that's what I hit, and that was it. So anytime you see that, that should increase confidence. Sanders saying, have to go, fantastic webinar, check their meeting probably. Good to have you here, thanks for coming. Where did I put my stop on this one and why? Well, where would you think I'd place my stop on this one? I actually did talk about in the trade commentary, I said how big my stop was. Anybody remember? No. I don't base my trades based on a pin bar or anything like that. 24 pips. 24 pips. So I had a 75 entry. That put me at 51. 51 was just a few pips below this here. I felt like, even though this level was clearly defined as rejecting, I felt like there might be a decent penetration into it. It may want to test the bids maybe close to the 30, but not quite. I didn't feel like it would get that far. So I said, okay, I'll have a 24 pip stop on this one because I feel like if it, this wasn't really a zone. It was it was kind of behaving more like a precise level. But I felt with the volatility that it may want to test a little bit past this. So I gave myself 24 pips of buffer, saying, hey, if it goes below 1050, then then this trade idea really wasn't valid, that we're no longer in a level, we're kind of in a zone area, and it's a larger zone than I thought. So I 24 pip stop, that was it. So that's where I put it, and hopefully that answers why. I have figured out lately that if you entered a trade correctly, you should be in profit relatively quickly. Sometimes, I would say oftentimes that's true, but sometimes the market can meander around your level. And that may or may not be a good thing or a bad thing. I've seen times where the market will just kind of sit there, and that could be for a variety of reasons. It could be liquidity, it could be timing, it could be that maybe the market needs a little more time to absorb it. Maybe you got in here and it took you, this is a 4-hour chart, so that's almost 2 days. Still a good trade. I was long on this one here, and it took me about a day before it finally turned around. And I didn't look at it as like, okay, but I would say that is often the case. That oftentimes the market will respond well. Obviously, the size of your target will determine that. If you're trading intraday, it should be a short time horizon before you know whether you're in a good trade location or not. But if you're swing trading and you plan on holding it for a 500 or 600 pip move, that could take days to weeks. So the time thing doesn't quite apply. Leon's saying, you don't talk about Elliott waves. Yes, and I don't talk about them because I actually, from my studies of them, I don't find it useful. The only thing I ever found useful out of Elliott waves was the concept of impulsive versus corrective. But even then, nobody inside Elliott waves has defined an impulsive or corrective move in the way that I did. I defined it based on price action. I couldn't find one Elliott wave trader that could define an impulsive move or corrective move the way I did. So I dug into it, dug in my price action skills and my mindset into it, and I meditated on it for like weeks and weeks on end. How would I define an impulsive move? And I defined it based on a price action method, not Elliott. And so if Elliott wave works for you, great, stick with it. Fine, stick with it. I have no problem with that. But I've only met 2 profitable Elliott wave traders in my entire life, and I've met a lot of Elliott wave traders. And it's so subjective, and it's so ambiguous. And I can't even get 100 Elliott wave traders to agree on the same chart. One time frame, one pair, one chart. I've thrown 100 of them in the. I've seen it, and I just can't get them to agree. Yet I can pretty much get a lot of traders who have a similar style to me that trades price action, and they can all agree this is their trade location. And they can all agree generally within the same target. And they can all generally agree where the strength is. So that's just me. Alistair's saying, for me personally, the blue candle would be my entry that closed after my buy entry because I really do need confirmations. I think you've convinced yourself you need confirmations, Alistair. And I think that's because you don't quite trust your price action skills yet. You haven't built these skills up. Nobody needs confirmation. You can create the mindset that you need it, but what you need is probabilities, not confirmations, because that confirmation that you think exists doesn't exist. And so you're saying that's your way of trusting the level. I would be willing to bet in time that's going to change as you get more experience with this. It's just you haven't built up those skills yet. Very much like in the first few weeks of driving, I wasn't really confident driving a stick shift until I had more experience. Okay, so Muhammad says, how many days you wait to retest the SLO to validate that level and trust it? I don't think of it in terms of number of days. It's just not how I think about it. It could be weeks, months, but I don't look at it as being validated based on the number of days. I look at it as what's the price action around that, and as the context supportive of it. Is there a strong reaction of it? Is it broken through it? If the market's not holding, it doesn't matter how, it's not holding. I don't look at it as like, oh, it's been 2 days and it's not enough time. I don't look at it that way. I'm not looking at it based on the time factor. Fuad's saying from this chart, can I buy from Second Touch? Yes, absolutely. And Gills, again, that was the whole point of the video series and all that I launched out. The idea of confirmation decreases your R to R tremendously. And Chun, there's a certain level of honesty. He says, I feel without confirmation, you are more gambling on that level, holding. Guess I need to change your mindset around it. Gambling is trading without information. It's just kind of, there's no statistics, there's no numbers. No, Leon, I haven't skipped your question. I'm saving it for later because it's not relative to the topic we're talking about right now. Anything that's not relative to the topic gets pushed to the back. So that's why I'm holding on it. So it's pretty honest of you, Chun, to say that you need to change your mindset about it. The thing about it is gambling is more just like playing without playing numbers, without playing with stats. If you're playing with stats and you're playing with probabilities, then there's no gambling behind it. If you look at the definition of, gambling versus the definition of using stats and numbers, you're playing probabilities. It's completely different. There's no gambling involved in this. It's only gambling because you haven't built up this skill yet. There's no way you can look at my accuracy ratios and say that's gambling. You don't have that kind of consistency in gambling. You only get consistency when the numbers are in your favor. And I think you all can pretty much agree I'm pretty good at calling trade locations and levels for defining areas. It's just something that you have to build up. Chris is saying confirmation stand 180 degrees again, taking a risk to get a reward. I think in the markets there is nothing that is 100%. This is totally true. There never will be in terms of a trade. It's all probability. That's why I kept saying you have to trade and think in probability. The more skills you have, the more you'll start to see probabilities. That will change. If you don't know what you're doing, if you're not working with information, you're not trading probabilities, then you are gambling. So, okay, last question. I got 2 more points, and I got to cover those 2 points in 20 minutes. Do you still look at the EURUSD chart after you've placed a long position? Because I found that I was always confused or emotional affected if I were looking at. That's a mindset question. Let's address that one later. Yeah. Okay. Should this have been an automatic buy order? If this wasn't, this sure as hell was. Yes. That's how I treated it. Again, my buy entry is in mid-candle. If it was after the candle closed, this green arrow would be right here. It was on the candle. It was as the candle was forming. I picked my level. That was my location. That's it. Would you agree with my thoughts that if I say daily was in a trend, 1 hour chart had been moving down and returned to a level that gave a strong rejection, as in the chart we were talking about? No, if you think about it, in my commentary I talked about what the context was. I said, look, I even said it before it ever happened. If we get a daily close above this range resistance level that had been holding, that changes the context from bearish to bullish. I was very clear about that ahead of time. So, Marco's saying I'm using Heikin Ashi. Should I change the candlestick? I don't have enough experience with Heikin Ashi to say that it has an edge or not. I couldn't. So, for me, I can only say that this does have an edge. Okay, let's go to number 8. Clear with trend, WT, rule reversal levels, RRLs, generally offer high profit potential trades. This is especially true when they align with the higher time frame context. So this should kind of make sense as well. What was I saying about in the euro yen? Range resistance had held for a long time. Same thing as the euro dollar. If it breaks, look for this to be a role reversal level to offer a great trade opportunity. What did I say? Buy at 131. I said, where's the support zone, or where's the main level? 131.30. What did it go to? 131.30.5. Went right to that exact same level. These levels tend to offer high probability trades. Why? Because especially when they're clearly defined like this. Do you see how there's not much variance around the level? Other than this spike, everything stays within about 10 pips of the level. It's very clearly defined. It's very precise. The more precise it is, the more profit potential it is. If every wick break of it was like this or even bigger, well then we're talking about a larger zone with less precision. So that means I have to have a wider stop, and that means I have less profit potential. But clearly defined RRLs, especially when they are with trend, offer high probabilities. This one was an RRL originally with trend. So if you weren't getting this one or you weren't getting this one, this is a great trade opportunity. This is a great trade opportunity. It reverses, it's still a great trade opportunity. So, should be pretty clear. Alice, you're saying, would I have seen something like a corrective wave coming into play on a lower time frame? No, that's why I even said before, I said it ahead of time, look to buy off of 131.30. Okay, let me give you another example of this. Really good example. Crude oil. What was I saying? If we break above 53.86, look to buy and a pullback into that level. It was a very clearly defined, it had held for like 2 months. What happens? Breaks, touches it, gone. Super high R profit potential trade. Same thing, clearly defined resistance, corrective move, now in a bullish trend with a bullish context, boom. High R profit potential. Even again, this one right here, you could have gotten away with a 30-point stop and you would have made a plus 3R in this one easily. RRLs, especially when with trend, offer, repeated, high profit potential trades, especially when they align with the higher context. This should just make sense naturally. Number 9, pullbacks and RRLs work well in clean volatile trends versus unclean volatile trend. This is a new definition because I wanted to expand on volatile and non-volatile. What's a clean volatile trend? A clean volatile trend is when the market respects prior resistance levels or support very cleanly. So this is resistance, it becomes support. This is resistance, it becomes support, and so on. Here's an example of unclean. And so I'm calling clean CVT, I'm calling unclean UVT, unclean volatile trend. Clear resistance level, it doesn't treat it. It kind of goes in the middle of the range. Here it's a little more clean. Here it's very clean. Here it's very unclean. It goes past the prior resistance. Same thing here. Here's resistance. Instead of holding that level, it blows right through it and kind of goes somewhere in between. Clean, clean, unclean. Obviously, unclean is much harder to trade. It's much more ambiguous. It offers lower profit potential. It means you have to have wider stops. It means you're not entirely sure where the thing is going to stop. A lot of times we'll be clean and it just stair steps its way up, but sometimes it's very unclean. And that is more challenging by default. Does that make sense? Is that a good definition for help you to understand the difference in volatile and non-volatile trends? I wanted to add and amplify this, so. And it should tell you if a trend is more unclean, then you have to have wider stops and you have to have a little more ambiguity around it. But when it's super clean like these oil things, by default, they're easier and they offer higher potential trades because it's very clearly defined where the market is treating as resistance or support. Mohammed saying, but in the candle, the crude oil break and the retest is just 2 candles. Do I trust this break? Of course, it has nothing to do with the number of candles. I was saying ahead of time, why would I be trusting this? Why was I saying buy if it breaks above it ahead of time? Why? Who can guess the answer to this question? Why was I saying to buy above it ahead of time? Not these, the first time. That's what Muhammad's talking about. The first time it broke it. It's key level, part of it. Squeeze, part of it. Well, I actually said it before the squeeze happened, so. Jack is onto something, market transition. It was a good level. It was a well-defined level. That's part of it. There we go. Tim got it. Thank you, Tim. Held for 2 months. If something holds for that long, it means it's built up a lot of stops around the other side of that level. If something's been clearly defined and holding very cleanly for months and months and months, it's built up stops over that 2 months. So with that being said, to me, if we break it, you're going to trip a lot of stops. I want to be switching context. That's why I said ahead of time. I even mentioned ahead of time, oil looks like it's going to bust through this level. I think I mentioned it like 2 days before in the commentary. If it does that, this becomes a role reversal level. You'll want to get long. So it has nothing to do with the number of candles. Tommy's saying, why didn't you mark the first test after the third red candle? You mean this one here? I just didn't want to add another arrow. It's a retest. It's the same thing. It's no difference. Okay, number 10. And this is important. And this may sound contradictory. And it's not. It's not contradictory. It's all one big package. How price action attacks a key level is information. It's not confirmation. It's just information. And it's certainly not the first criteria. That information can offer additional clarity whether it will hold or not. A pre-breakout structure is highly informative of this. Impulsive price action into a level is decently informative. But as we've discovered, just being impulsive doesn't mean much. How many times in these other situations, you know, this is slamming into that level impulsively. This is slamming into that level impulsively. Impulsive by itself is just information. That's the same chart. Again, yeah, same thing here, even further back. Slamming into it impulsively. Slamming into it impulsively. Slamming into it impulsively. Slamming into something impulsively doesn't determine whether it's going to hold or not. It's information. It may be helpful information, but it's not a clarifier. It's not a criteria by itself. It's not like it's impulsively hitting it. That's it. I'm bailing. It's additional clarity, and it's one piece of the puzzle. Pre-breakout structure is another piece of the puzzle. Now, great example of this, which seemed to have angered some people, which was euro dollar. I was short. I had a pending order to sell here. I think I was short at like 50 or 45 because it kept forming higher lows. So I pushed it up my entry back a little bit. My resistance zone was between like 110.30 and 110.52 or 51. So I pushed it up to the high end of that zone because pressure was building up to it. The day the trade happens, what happens? We have impulsive, corrective, pretty much no wick on the bottom. Straight buying from the open of the candle, 1 hour chart. Hits the level, finds sellers, breaks through the highest to 150, 1050. It breaks through it for the first time in like a month and a half. Sellers come back in and try and say, we're going to try and hold this, but then look what happens. Opens, little dip, huge buying right off the bat. And on a 5-minute chart, this is what it looked like. I think it was Colin, I'm not remember sure. Somebody said, why did I get up for -5 pips? Because I was looking at that in real time and I said, this doesn't, to me, look like something I want to be in. It just doesn't look like it. I had an entry at 150. I think I had like a 30 pip stop on it. It did this. It almost hit my stop the first time. I came back into profit, but a mild profit. But I'm looking at this. I'm like, this is a pre-breakout scenario. This is now, just kind of hovering around this. And I was like, I just did not like it. I did not like the read on it. Everything in my subconscious mind was saying, this is hitting it way, it's, the pressure's been building up. Something doesn't feel right about this. Turns out it was the right decision. I exited out for 5 pips. I said, I don't like this. I think this is the day it's going to switch from short to long. And what happened shortly after? I exit out. It forms a pre-breakout scenario, squeezes, boom, it's gone. It just didn't make sense to me. So I exited out fast on this one here. But here's the thing about this, and I say that it's with a word of caution. Why is this? Because this is managing a trade in real time, and managing a trade in real time takes immense amount of skills in place. It has the skill, the mental skill of being disciplined and non-emotional about it, and that takes time to build up. It takes the mental skill of having confidence in your price action abilities to read price action in real time, and that is a skill that takes time to build up. And it also takes the ability of discipline of managing a trade. And if you can't sit through a trade going, as I talked about before in terms of managing trades, before you can go on to managing trades in real time, 1 hour, 2 hour, 3 hour trailing stop and all that, you have to have the base level of discipline to do that. Managing a trade and taking profit and adjusting profit and stop loss in real time takes more discipline, more price action skills, and more confidence than somebody has in the beginning. So how do you build up that discipline? Well, what did I say? And this is answering Hamza's question into someone else. So I said in the beginning, take 100 trades, live or demo account, ideally live, at pure set and forget. When you can, on 90% of those trades, let your trade either hit stop loss or take profit, you've shown you have enough discipline wired into your brain to be able to allow the trade to fluctuate between stop and loss, profit and loss, positive and negative, to trust your analysis, to trust your ability to let that you picked a good entry location, a good stop loss location, a good take profit location. You've shown discipline. Once you have that base level of discipline in place, then you have enough discipline to start managing trades, to start saying, I have the skills to sit with this mentally and allow it to be in profit and loss without my emotions, or even my emotions come in, but I still stick to my plan. So I don't suggest managing trades until you can prove to yourself, and ideally to me, that you can log 100 trades demo or live and let them go to hell or high water. And if you did that 90 out of those 100 times, then I feel 100% confident that you have the discipline wired into your brain to deal with the emotions, to deal with the swings, to deal with things being profit and loss without making a bad decision. And then at that point, if you can do that and you can send me your trade journal and show me your trade report demonstrating that, I don't care if it's demo or live, then I will teach you how to manage trades. But you have to build that core level of mindset in place, that level of discipline, because when you're managing it in real time, there's a lot more variables in place, a lot more emotions, and a lot more skill involved. And you need a greater level of discipline to manage trades, to hold trades, to lock in profit, to adjust your stop loss. So that is a stage. Set and forget is a stage. It's not the most efficient stage though. If I can lock in plus 3R with a relative degree of confidence, that's far better than my fixed plus 2R target. If this thing may go for a plus 7R runner, plus 9R runner, one of those is worth 4.5 of my plus 2Rs. So there's a lot more, as Chris says it perfectly, there's a lot more steam on the kettle. Brilliant analogy there. Okay, Mohammed has a question, and I want to get into a few more charts, and then I got to wrap this up. Chris, what is the PA I was needing to see on the 5-minute chart to still be in the trade to the end? Well, I exited for a 5-pip loss very, very quickly. If I remember correctly, I was in and out inside of like 5 or 10 minutes. I just did not like it at all. Everything to me was screaming, this doesn't feel right, this doesn't make sense. And it wasn't just the 5-minute chart. I was looking at daily 4-hour, 1-hour, and 5-minute. And all of that was looking at, just all screaming to me, this doesn't feel right. It had never even gotten past 110.50 ever, and now it's past it. This just doesn't make sense. This is not what, this just doesn't look to me right. It was more of a subconscious read. It wasn't like, oh yes, this one thing on there. It was a combination of things. And it wasn't just the 5-minute chart. It was the 1-hour chart, the 4-hour chart, the daily chart. It was the whole picture. It just didn't make sense to me. So I exited it. And that was that. Jerome is saying, is it possible to get the slides of this webinar in a downloadable form on the site? No, because that could be distributed for free. So I would like, I would like it to be a world where I knew 100% that nobody would distribute it to free, but unfortunately there are some people who don't have my best or your best intentions in there. There are some people who are really wanting to distribute this for free. So I apologize if I can't. Benson's saying, does it set and forget mean we shouldn't even move to break even if it is defined in a trading plan? Correct. Why? Because what is break even? That's a managing of the trade. It's a managing of the profit and the risk. Pure set and forget is hell or high water. And that takes a certain level of discipline. Moving it to break even is a management tactic. Before you move things, before you even get to that stage, build the discipline and mindset that you can live with the trade results. Because then you start thinking at things in terms of probability. You realize there's a huge swing of emotions and it didn't really mean as much as you thought it would. You're willing to sit through that and stick to your decision. That creates confidence. There's a reason why I've set that as a stage requirement. Let me give one more example of this, just to kind of demonstrate my point. Look at the impulsive selling heading into 110.70. Impulsive selling into a level is information, but that's not a criteria by itself. This is an impulsive move heading to the level. What happens? Immediate reversal. Buyers said, we are in control. You guys are stopped out. You had your day. They bounce it again. That's why I want you to understand you have to take all the things as a whole. Now, with that being said, I only have a few minutes, and there were some questions that I left unanswered. For all the people that had zone questions, I think I've already answered it. Hopefully. And somebody please remember the options. So LLT is the current 3-letter thing for automatic trade or a limit level trade. But somebody please store in their brain, LST for limit sell trade, LBT for limit buy trade, and Austin's idea, LTO, limit trade order. I like that one. I will test to see which one sounds the best. Now, first question. Of the unanswered questions. And I'm only going to be answering these unanswered questions, and that's it. So don't try and squeeze in 1,000 questions now. Leon saying, question on liquidity. I've had a lot of success by deciding to focus on one pair of US dollar only, and I'm wondering how good the liquidity is. It's the most liquid pair on the planet. It is the most liquid pair on the planet. You will not be able to exhaust the liquidity, Leon. I guarantee it. Flawed Milkup says, so breakout squeeze can fail by strong support resistance level. Of course it can. Of course it can. Of course it can. But again, we're not worried about whether it's failing or not. We're trading the probabilities. Leanne's saying, I personally don't have problems trading SR levels, but I'm wondering how you came up with the idea. No other price action educator teaches this. Did you get it just from your 15 years in the industry, or how did it come to you? 15 years, 45, 50,000 hours behind the charts. I've absorbed a lot of price action. I've absorbed, a lot of things in the industry. That's just in my brain. I've stored, millions and millions of candles and patterns. And it's not, that's the other thing. All those other cut and paste derivative people say buy pin bar, sell pin bar, confirm this, that. What are they all saying the same thing? Well, I mean, one of them even wrote an article. You should only spend 30 minutes behind the chart. Just walk up. Do you have your setup? No. Okay, bye. It's the most ridiculous thing ever. It's just absolutely insane. Try and learn piano that way. Try and learn a new language that way. Good luck with that. That person who normally speaks French with me isn't there. I shouldn't practice. I shouldn't go to the store and talk to somebody. I shouldn't ask questions with the taxi cab driver. I shouldn't read a book on it. I shouldn't look online or watch a movie with subtitles. It's effing ridiculous. It's a fantasy. I'm not saying, look, if you're a busy person, you shouldn't try and be very efficient with your time. That's true. You should try and be as efficient with your time as possible. But we don't just sit there and go, okay, bull trend, bear trend, no pin bar, sorry, I'm out. Have a nice day. You're never going to build your skills like that. It's just not, that never happens in any skill-based endeavor. I'm not doing that. I'm in the trenches. I am digging into this. I'm studying. On last Friday, what was I doing after the market closed? I was on FT2. I was going over charts of trades that I'd won, looking for patterns. That's, I'm in the trenches and doing that. That doesn't mean I don't enjoy life. I go out and enjoy life. I go do things. I go do fun things. I do these things. But you'll notice the difference between how I describe price action and how they describe price action. They've been describing the same shit for years. There's no evolution. I'm constantly evolving things because I'm constantly working with the material in my mind. I sometimes sit there and meditate upon price action. I will sit there and say, okay, I've seen this pattern. What is it? And then I will meditate and I will try and unlock that pattern and see what I can dig into this. That's how I came up with the idea, clean and unclean volatile trends. I don't just sit there and say, no pattern, sorry, bye, have a nice day. That's a hobby. That's a freaking hobby. That's, if you want to do this as a hobby, fine. Then call yourself a hobby price action trader. Don't call yourself a professional trader. There's no hedge fund that just kind of walks into the office, spends 30 minutes, says, nothing there, let's go out and have a nice day. There's no prop trader that's doing that. There's no bank trader. Even if you were to tell a bank trader, okay, we're going to give you a salary. We're going to give you a base salary, but the majority of your salary is based on your performance. There's no bank trader that just, even if they had the opportunity to not be in the bank, compare that person who walks into the bank, spends 30 minutes at the charts, makes his trades, and then walks away. Compare his performance to the guy who sits there for 8 hours a day. The guy who's making that high-end bonus, he's the guy who worked it. If you're going to do that, call yourself a hobby price action trader. Don't call yourself a professional. No professional spends 30 minutes a day doing their skill and craft. No professional spends only 30 minutes a day on their profession. You're a hobby trader. Trading is a hobby for you. It's not your profession. Okay, I don't see any other new questions. Or the old ones. I think you can have some peace of mind about the distributing, because stealing someone's material is ruining their karma. Yeah, but that's still, but it doesn't protect you guys. It doesn't protect all the work that I've done. I have peace of mind about that, that situation, but I've spent thousands of hours protecting this material, and it's not fair to you guys that you spend your money and somebody else gets it for free. It's disrespectful to you. So, okay, I think that is it. I have to get going. So, Jack's saying, I'm new here. How can I get access to recorded webinars? We usually post them after a couple days, so they'll be up. Okay, yeah, I think I've answered all the questions. Sure, that Chris is saying, some of us, or a lot of us start as hobby traders, and that's totally true. And if you're going to be a hobby trader, then just be honest about it, and just say, look, this is a hobby for me. And train as if it's a hobby for you, and approach it if it's for a hobby, and expect hobby results. Don't expect professional results. So, you just have to be honest about it. Okay, I have to get going. I think we've covered all the material that we want to. So with that being said, I hope this adds a lot of clarity. I hope this really amplifies and answers a lot of questions about support and resistance. And so with that being said, that doesn't mean that the conversation's over. No, we'll have more in this conversation. But I want you to learn these things first before we go into other things about support and resistance, because there are a lot more things I'd like to teach you about it, but you can't treat it as information. You have to learn these 10 things inside and out. When I feel that a lot of you have learned them inside and out and can demonstrate it in the trades you're picking and how you're talking about price action and levels and entry, low, and trade locations, then I will bring in the next conversation about it. So thank you very much for this. I appreciate you guys taking the time to be here. Some awesome questions and your participation. I look forward to hearing from you guys in the course. Again, it'll be up in a couple days or something like that. So please have some patience on that. My recording team isn't working on the weekend. So have an awesome weekend. Enjoy your weekend. And remember, I take this seriously, but I don't take trade seriously. We're not solving world hunger here. We're not doing open heart surgery. It's trading. No trade is life or death. Stop treating it as life or death. Stop treating it as something that's like your entire life depends upon it. It doesn't. It's just a trade. You're just playing with money that you have to play with, and that's it. So, with that being said, go enjoy something in your life. Go have fun. Go do something that makes you feel great and expands your brain. I bid you all adieu. I wish you good luck this weekend, and I will see you guys back in the course. Take care, everyone.